All right, ladies and gentlemen, I've only got one person on today, so Gaius, this is really geared towards you and for any others that might join later on. We have at Woodburn Accountants and Advisors a weekly Thrive in China roundtable, and the objective of these roundtables is to have discussions around the theme of that week. So the theme of this week is looking at tax incentives that have been initiated for SMEs in China, how this can potentially benefit you, and ultimately the question for debate at the end of this roundtable is actually tax planning something that can actually be done if the regulations are consistently changing around the taxes and tax incentives that are imposed upon companies in China. So I'm going to give about a 30 to 35 minute presentation around the topic. Before we start, just a couple of tech things. How the roundtable works is I'm here to educate you on what's happening right now in terms of tax incentives in China. What does this mean? How you can benefit from it, how you can do those applications. If you've got any questions at all, you can either wait till the end or you can insert them in the chat section. Again, this is your time spent, so use it wisely. There's no dumb question when it comes down to China, all right? And as people are slowly trickling in, just note the smaller the group, the more availability you have to ask questions and get a one-to-one advisory ultimately during this roundtable. So who am I? Well, my name's Kristina Koehler-Coluccia. I'm the head of business advisory at Woodburn Accountants and Advisors. I'm almost 18 years in the corporate services and corporate compliance sector in China, which means I live and breathe administration, accounting, tax, payroll, banking issues in China. I've helped over 500 companies with their market entry, their implementation, and their growth in China. You can imagine the most fun part of this job is actually helping companies to systemize their businesses and to actually scale up in the Chinese market. So that's just a little bit about myself. In 2020, I wrote a book, The 10 Biggest Mistakes Companies Make in China. And if you're interested in getting a free copy of that, ultimately they're the 10 biggest mistakes I have made in China. I should probably rephrase the wording. But if you'd like a copy of that, you can email me at Kristina@woodburnglobal.com and I'll get a copy over to you. So the theme for today is how to benefit from China's tax incentives for SMEs and how you can actually potentially benefit from that. So I know a lot of you are probably already operating companies in China and you'll know the basics, but for those of you that are thinking about going into China, I have provided a little bit of background, which hopefully will be a nice refresher for those of you that are actually doing business in China. So profits tax in China. Who is considered a tax resident in China? So there's a whole bunch of definitions, but ultimately, I think I want to highlight two key things. One, if you have an entity that you have incorporated in China, it means that you are a tax resident in China. Second, if you have all of your effective management sitting in China, either going over the manufacturing and business operations, HR, financial, if that's all there, then you are also considered a tax resident. Now, for those of you that don't have entities in China, you can become a tax resident if you have permanent establishment within China. And that entails the effective management component and entails having people on the ground in China who you are paying salaries from abroad, but they are actually residing in China. That will make you have tax resident. And there are time limits depending on the double taxation agreements between China and the country of your HQ or the country where these individuals have come from. So it's important to realize, you know, are you a tax resident or not? Very simply, if you have an entity in China, you are. And if you don't, that's where the tricky question lies. Are you a tax resident or not? And that will really depend on whether you have people on the ground, the length of time of those people on the ground, and the activities you're actually performing on the ground. Again, any questions, or if I'm talking too fast, Gaius, it's only you, so just message me if I am. So if you have an entity on the ground, there are rules that will dictate your compliance. Very simply, the rules are, in China, the fiscal year is January to December, so you are following a calendar year timeline where your reporting is from January to December. Corporate income tax, profits tax, is paid quarterly. Declarations are in April, July, October, and January of the following year. All right. The annual corporate income tax filing declaration is done in April or May, and that will depend on your tax bureau and your tax officer to dictate the deadline to you. That will be the following year as well. So you can imagine right now we're in peak season, completing all of the annual audits so that we're ready by April, May to do the annual tax declarations and the annual inspections. Something that I want to mention here, because this is a component of your tax planning, is that tax losses can normally be carried forward for a maximum of 5 years, starting from the year after the year in which the loss was incurred. So you have 5 years to carry forward your losses, okay? During COVID, that was extended to, so in 2020 was COVID. That means if you had a loss in 2020, that loss can be carried forward for 6 years, okay? Carryback of losses is not permitted in China, but this will just give you an understanding of what the rules are. Now, I listed a bunch of questions here, because this all comes down to the incorporation stage, the planning stage for setting up in China, and the running of the company, to eventually know what your tax status is going to be, what tax rates are going to be imposed on you. So the first question I have for most companies that come to me, even before they're incorporated, is when are you planning on being profitable? And if they can't answer that, that ultimately means they've never done a budget, long-term budget, to really analyze when profits tax will start being an issue. Then you have certain industries where you can apply for getting reduced tax rates. So for example, if you're considered a high-tech enterprise, if you're considered a technology advanced enterprise, if you're a production software company, i.e. you're producing software locally, if you're, again, a clean tech organization, then in those types of categories, as well as others, you can apply for preferential tax policies as well, okay? But, and I'll give you an example of a couple of these later on, it is extremely difficult to file an application and get approved. And I'll explain to you why later on. And the criteria that is required to fall under each of these categories, you must be thinking about that criteria as you're establishing your company. The next 2 points that I just want to highlight that are questions is, are you going to choose your location in China where you're going to actually set up your company based on the preferential tax policies of that zone or that city? And if so, again, the question comes to the first one, when are you planning on being profitable to then benefit from those special tax rates? And last but not least, are you planning to implement repatriation strategies where you repatriate monies before you're declaring profits tax in China? If yes, when are you planning on implementing that? When are you going to execute that? And how are you going to add that into your tax planning? So these are big questions, right? And that's basically the background and the foundation, how I work with my clients to understand, what are you going to do in China, right? You have to plan for the future and know how then the structure you're setting up fits that future. Basically, to give you further foundation, and again, those of you that have entities in China, this should be ingrained in your head. Profits tax applies to all companies in China, regardless of nationality and ownership, whether you're foreign owned or whether you're Chinese owned. The general profits tax rate is 25%. I just want to add a comment here for those. I'm not trying to treat you as if you're dumb, but there are 3 different ways that we say profits tax in China. Profits tax, enterprise income tax, and corporate income tax. So I don't want people to get confused, but CIT, EIT, and profits tax are all the same thing, okay? And that's at 25%. It's unified throughout the country unless you're benefiting from one of these tax incentives, okay? And if you are doing your own research online, okay, then you've probably read how tax rate has changed, and you're probably maybe a little bit uncertain about what the current rate is. The current rate is 25%. Prior to 2008, there were different rates depending on whether you were a domestic company, foreign company, and also depending on where you were established in China. That's all gone. It's a unified rate of 25%, where if you then apply for the preferential tax incentives, you will get lower rates. How is profits tax calculated? Again, I call it on a FAPTAO basis. It's not very technical. That's not used in China. That's not the word that we use professionally, but I feel like that is what's going to get into people's minds. In China, when we do our accounting, it's very much FAPTAO accounting. It's FAPTAO basis. So profits tax is calculated based on the income and expenses that are recorded at the time that the FAPTAOs are issued and received, okay? It is not necessarily based on accrual accounting, which we all wish it were, but in many instances, it is not. If you would like it to be based on accrual accounting, you could do that. You would just need to have a very good communication with your tax officer to explain the reasonings why month to month you're doing accrual accounting versus FAPTAO accounting. And depending on your resources, those explanations can take a lot of time. So it might delay the month closing because you're always explaining to the tax officer about your accrual adjustments. Now, profits tax is calculated and paid quarterly, usually within the 15 days of the period end. So I highlighted earlier, April will be our Q1 profits tax declaration, okay? And the deadline is around the 15th, 16th of the month. Then it's reconciled annually as part of the company's year-end audit, which is what we're doing now for all of our clients for 2021. And you then do an annual profits tax declaration, okay? Now, again, this might be known to everybody. It might not be known, even if you have an entity. So I do want to highlight again, what are the allowable deductions for profits tax so that you are familiar with this, okay? And obviously in the startup phase, none of this may apply to you, but as you are scaling up and growing up, these things will become part of your daily business. So what is allowable for deductions? Business costs and expenses. Entertainment expenses are 60% deductible up to 0.5% of the total income. Advertising is 15% of the total income is deductible. Donations or donating to charities, for example, is up to 12% of the total income, meaning there are thresholds for these things. So you should be aware of what these thresholds are, okay? It is critical because if you don't think about this throughout the year, there may be penalties or repercussions as you're doing the audit and the annual profits tax filings. Then you have also deductions available on property tax, stamp tax, dividends, and other types of taxes. You have a depreciation of fixed assets, which are deductibles, amortization of intangible assets, as well as any other local tax incentives that may be imposed where you are actually establishing your business. But I just want to highlight and finish off that foundation for you with one question. I work with startups in China. Startups for me mean companies that may have been transacting with China for 20 years, but once they're establishing their company, they are a startup, they are new. And the biggest question I have for these companies is, when are you planning on being profitable? And as part of this session today, I am going to provide you a case study of a typical client of mine and when they might actually become profitable. Because most companies try to make their incorporation decisions, I don't want to say predominantly on tax incentives, but a good 30 to 40% of their decision making is composed of the tax incentives. So I want people to really get the idea of doing tax planning to realize when these tax incentives might actually come into play. Now, the highlight of today's session is what are the incentives that are being offered to small or low profit companies in China? Okay, first of all, there's 3 criteria. 1, the company has to have, cannot have an annual taxable income of more than 3 million renminbi. Taxable income means gross profit minus general administration expenses, and then you're looking at your net profit. Okay, so your net profit is the taxable income. Okay, and that should not exceed 3 million renminbi. You should not have more than 300 people on headcount on payroll, and your asset value should not be more than 50 million renminbi. Okay, so this is really geared towards startups in China. Okay, the startups that are scaling, growing, and are starting to become profitable. Now, this is the terminology that is written in the law about what the profit tax calculation is. I've simplified that for you to make it easier. So basically, translation of that is companies whose taxable income is up to 1 million renminbi, an effective 2.5% profit tax applies. Note, this is supposed to end in December 2022. So if you've got a taxable income of up to 1 million renminbi, you're only going to pay 2.5% profits tax, which is fabulous, particularly in the age of the pandemic, the Ukrainian-Russian war, trade tariffs with the US. The government has actually extended this to the end of 2022. However, my feeling is something like this will remain after 2022. It's just they will probably up the 2.5% perhaps to 5% or 10% or something like that. But it just means that as a small company in China, and you are starting to generate taxable income, then you're getting benefits out of this. I mean, I personally don't know anywhere where you're going to get 2.5% of the profits tax on that. Now, companies whose taxable income is between 1 and 3 million renminbi, the effective rate is 10%. Now, this ended in December 2021, but I will be curious to see in Q1 what this is actually going to look like, because there has been no formal announcement that it has really ended, or that there's been any form of revamping to it. There's only been a revamping for the first line item there with where up to the 1 million, it's 2.5%. So I'm curious to see in Q1 tax declaration how this will be impacted, and whether it will still continue or not. So that is a to be confirmed section right there. Now, other profits tax incentives which exist. Now, I want people to realize, all right, hold on, let me just recap that part. If you are a small company in China, you are growing and you are starting to generate taxable income, right? Don't start analyzing about how to get money out of China prior to that. Take advantage of that 2.5% profits tax, because in this growing up phase, you will still need capital on the ground to reinvest into the company. So, don't start thinking about profit repatriation when it's 2.5% profits tax. You're going to spend more on taxes repatriating it out than if you just declare the profits tax and leave the money in. And so I want you to be aware of that ahead of time. Other profits tax incentives. So if you are in the high-tech sector and you apply to obtain the status as a high-tech enterprise, you can get a profits tax rate of 15%. Okay. Now, I wanted to highlight here what are the criteria to obtain this 15% profits tax rate. Okay. The first criteria, and for me, the most risk criteria, is that the core IP, right? We're talking about high-tech enterprises that obviously will have IP in the form of patents, most probably. These patents need to be owned by the Chinese entity. Okay. And they need to have exclusive licensing arrangements that are no less than 5 years. Okay. Now, the big question there is, because again, this is really a risk to have your Chinese entity own the IP, is whether you want the Chinese entity to own the IP or whether you want to hold that IP and have control over it in your headquarters. If you are making that decision of there's no way I'm bringing my IP into China, then there's no way for you to get accepted to become a high-tech enterprise. Okay. The second point to that is that at least 30% of your employees are required to hold diploma certificates or higher degree certificates. So you have to be aware of that. And then last but not least, R&D expenses are reduced from 6 to 5% of annual revenue for enterprises that have no more than 50 million RMB in annual sales. So there, there is the R&D aspect that you have to also look into. I just want to say that I had a client about 10 years ago, a Swiss company. They opened up a subsidiary in Shenzhen, and they were a clean tech, high tech enterprise. And because they would not put the IP of their technology into the Chinese company, they were not able to obtain the status. But the problem lied in the fact that they created their China budget based on getting this approval and being able to benefit from the 15% profits tax rate. So I just want to highlight here, you first have to incorporate your entity in China. Once that entity is incorporated, you then have to decide whether you're going to fulfill these criteria. So it won't be immediate. And you have to make that judgment then when you're creating your budget. You know, do we keep the regular rates of taxes versus going with the preferential tax incentives? Because we're not sure, there's no guarantee that we will obtain the approval. Okay, then in the Western regions, so there was a lot of promotions from Chongqing, Chengdu, and Western China to get foreign investors to go over there. And for these encouraged industries, they were allowing a 15% profits tax. This has now ended since December 2021. Okay, so I just want people to be aware of that. So there's been quite a few changes, 2021, 2022. Now, infrastructure projects are also getting preferential tax incentives. This is for transportation, water, environmental protection, and they have very nice incentives here where it's a 3-year profit tax exemption followed by a 3-year 50% reduction in profits tax. Now, generally speaking, construction companies in China cannot be wholly foreign owned. They would need to have joint venture partners because it is a restricted industry, as well as infrastructure companies. So please be aware of that, that these preferential policies might not impact you unless you have actually a joint venture structure. Now, preferential tax treatments can also come depending on where you're based. So if you choose places like special economic zones or pilot free trade zones, so for example, Shanghai, there's Lingang, in Shenzhen, there's Qianhai, where you can get automatically a 15% profits tax rate if you base your company in these zones. Okay, but again, I'm going to raise this question: when do you plan on being profitable to pay these special rates? And there are tax exemptions for companies that I have not mentioned yet in the agricultural, forestry, fishery sectors, software and technology development, where you can also obtain exemptions. Okay, and that's just throughout China. All right. Now, one of my key tips at the end of today's presentation will be on communication with your tax officer. You need to be open with your tax officers to see whether any of these exemptions or tax treatments can be implemented for you. If you don't have that open communication, you won't know, right? And your tax officer won't even know because you're not openly discussing with them what your business scope is, the types of transactions that are running through the company, etc. It is an application to get these treatments, to get these incentives, all right? Apart from the 2.5% of up to 1 million RMB, and that's automatic because that's going to be based on your P&L. which is submitted, and that those tax rates will be implied. It's important though that your accountants are aware of these regulations, otherwise you won't have benefits. So I'm going to rephrase again the questions that I put earlier, right? When are you planning on being profitable? Are you a high-tech enterprise? Are you a technology advanced enterprise? Are you a production software company, clean tech company? Are you in agriculture? The biggest question here is understanding what are the criteria to benefit if you are one of these types of companies, and whether you are ready to fulfill the role of putting IP locally in China. And then are you going to decide your tax planning based on where you're going to be to benefit from the tax rates? And then last but not least, again, repatriation strategies. How are you going to get money out of China? When are you going to get money out of China? The next tax incentive is on value-added tax. And again, just a foundation. When you register your company in China, you are going to obtain a TIN registration number, which is a long number that is on your business license. This TIN registration number is also your tax registration number. And it is something that is then used on all the fapiaos and receipts that you pay for. In China, there's an important distinction you have to make between being a general VAT taxpayer or whether you are going to become, or whether you are going to remain as a small scale taxpayer, okay? The criteria for this are based on annual taxable sales amounts. When you establish your company, you will automatically be a small scale company. And the question then is whether you want to apply to become a general VAT taxpayer because you know you're going to be generating high revenue volumes, okay? That's the basic I want you to understand. The difference between the two, small scale taxpayer, basically, if you are a small company, your annual turnover is minimal, then remain as a small scale taxpayer. Usually, if you are in trade and you hit a turnover of 800,000 RMB, your tax officer should be asking you to upgrade to a general VAT taxpayer. If you're in manufacturing, the threshold is 500,000 RMB. If you're in service, it's 5 million RMB. Okay. Now, why is there such a difference between service and trade and manufacturing? Because in service, we have nothing to offset, meaning we have nothing to buy. There's nothing where we can offset the initial VAT that we pay for, because we're a service company. We're actually just invoicing. There's no third-party suppliers where we buy things from or anything like that. So that's why the threshold limit is quite high. Now, small scale companies, small scale taxpayers, they calculate VAT based on a 3% rate. And you cannot deduct any input VAT, which is the VAT you pay on purchases, because you can't. One thing you need to keep in mind is that compared to the past, you can still issue special VAT fapiaos to your Chinese clients. It's just an application that has to happen at the tax bureau. And special VAT fapiaos are important because those types of fapiaos are used for the deduction for those clients who are going to be general VAT taxpayers. I just want to highlight, I'm doing a whole session next Wednesday on VAT alone. This is a very quick run through. General VAT taxpayers, there are usually 6 different tiers and brackets. Not 6 different tiers. There are different rates depending on the industry that you're in. So for example, if you're in the service industry, as a general VAT taxpayer, your VAT is at 6%. If you're in logistics, I believe it's 10, 11%. If you're in general trade, selling, buying general products, it's 13%. The advantage of being a general VAT taxpayer is that you have the ability to offset your input VAT on purchases, right? And you have the ability to issue on your own special VAT invoices. So you're running basically the VAT system where the VAT payable is the output on sales, the output VAT on sales minus the input VAT on purchases. Okay, now tip. This is my biggest tip I'm going to give you guys. Again, for foundation basis, you set up your company. Nobody is forcing you to become a general VAT taxpayer unless your business strategy is that you are going to be transacting with high value and high volume of business immediately. then I would say, go ahead, become a general VAT taxpayer. If you are a company that is starting up and you have one transaction every so often and the volume is not big, the volume and the value is not big, then why not stay as a small scale taxpayer and evaluate over time, right, by creating simulations when you should upgrade to become a general VAT taxpayer. We want to create a VAT optimized structure, just like we want to create a profits tax optimized structure. So don't rush into this decision of becoming a general VAT taxpayer. You want to do that over time and evaluate what fits you best based on your business model. Okay. Why do I say this? Because once you're a general VAT taxpayer, you cannot go back, become a small scale. A small scale, you can remain as a small scale until you hit certain thresholds. And then your tax officer should advise you to upgrade to become a general VAT taxpayer. But creating these simulations could be of huge advantage to know at what point you should be doing that upgrade, again, in order to be able to optimize your tax situation. Now, what are the current incentives for small scale taxpayers? There are no incentives for general VAT taxpayers. Unfortunately, there are only incentives that are imposed by small scale taxpayers. So basically, there are two incentives. One is the levy rate and one is the increased VAT threshold. So as I said earlier, if you've applied for the general VAT taxpayer status, this will not apply to you. And unfortunately, you cannot downgrade yourself back. But since the COVID-19 outbreak, which happened in Wuhan, the government has basically said that if you are a company established in Hubei, but also if you're a company established anywhere else outside of Hubei, you have the benefit of a reduced rate from 3% to 1%. This is still in applying. As a small scale taxpayer myself, we are still continuing to use the 1% VAT rate. It is not clear to anybody at the moment when this will be lifted. So I've not put an end date to this because I've not heard anything in terms of when that deadline might be. Could be end of this year, could be next year. Nobody actually really knows. So I want you to be aware that when you are then issuing invoices, you can issue an invoice with a 1% VAT versus a 3% VAT. It's a great advantage to have. Now, in addition to that, there is a VAT exemption threshold, which is based on the revenue you are earning month to month, quarter to quarter. Okay. Now, this I know will end December 31st, 2022. Okay. So the threshold basically has been increased that if you are earning a revenue of 150,000 RMB per month from the previous 100,000 RMB per month, you can actually be completely tax exempt from VAT, i.e. you do not pay any VAT whatsoever. Okay, so I just want to highlight that for everybody. If you earn 150,000 RMB per month or 450,000 per quarter, you are completely tax exempt from VAT. Now, education surcharge and tax reduction. If you guys are not familiar, you might see on a lot of invoices, I do it myself, I charge 1.5% VAT because it's VAT plus surtax. Most of the time, nobody knows what that surtax actually means. Surtax is actually the education surcharge that has been issued and you have to take into account when you are invoicing your clients. So, if you're issuing an invoice for the sale of goods of 13%, don't forget to add the education surcharge. If you are a general VAT taxpayer selling services, you have to account for the 6% plus the surcharge. So if you were a general VAT taxpayer, I would say round it off to 6.8% VAT and surtax so that you know, and you're charging that to your client so that you are not paying a single penny out of your own pocket for that surtax. As a small scale taxpayer, we do 1.5%. And like that, I'm clear and I know that I'm not incurring any liability in terms of paying that surtax out of pocket. Basically, how it works currently as a tax incentive is that taxpayers whose sales amount does not exceed 100,000 RMB or 300,000 RMB per quarter, they are exempt from the education surcharge, local education surcharge, and the water Conservancy Construction Fund, which is a great advantage as well. So if you are earning, I don't know, less than 300,000 RMB per month, you actually are VAT exempt, and you're also exempt from all of these surtaxes that are imposed. Okay. If your revenue is, I don't know, 350,000 RMB per quarter, you're still going to be exempt from VAT, but you'll be required to pay for the local surtaxes. Okay. Now there are additional exemptions on offer, but that really depends on the locality that you are in to see whether that will be imposed or not. Okay. The local governments are also granting authority to reduce 6 types of taxes and 2 fees on small-scale taxpayers. These are resource tax, urban maintenance construction tax, property tax, urban land use tax, stamp duty, which is the duty that is paid on all contracts that are signed, the arable land use tax. So a lot of this might not even apply to you except for the stamp duty, and the urban maintenance and construction tax. Otherwise, for points 7 and 8, this was mentioned earlier in terms of the surtaxes. So there are quite a lot of incentives for small-scale taxpayers out there and small business owners. Now, individual income tax, I'm pretty sure that a lot of people aren't aware of this. I just want to emphasize here that this is literally for companies that are owned by individuals or sole proprietors or FIPs, partnership enterprises. These 3 types of companies can benefit, where the owners can benefit from individual income tax relief. And it's basically a 50% reduction of your income tax. So on the salary that you earn, you get a 50% reduction on the individual income tax owed, as long as the business operation, the income from the business operation does not exceed 1 million RMB. Okay. Again, if you don't know about these regulations, the tax officers tend not to educate you on them. So that's why I'm doing this presentation, is that if this does apply to you, take it to your tax officer and say, hey, you know, I want relief now. So I want you to be aware of that. There are also tax measures to lower financing costs for small businesses. So obviously, due to the pandemic, a lot of small businesses went to the banks to obtain loans. And a lot of the financial institutions were saying no to them because, you know, why bother helping a small business provide a loan when actually the VAT costs, stamp duty costs are going to be a lot higher than actually what we're providing to them as a loan. So what the government has done is basically they've said, okay, we want the financial institutions to support these small businesses. If they need to raise funds, then they will be exempt from paying VAT on the interest. Loan contracts, there's no stamp duty whatsoever. And both of these measures are still going to be imposed until the end of 2023. So if you are a small business looking to raise funds, take advantage of this now in 2022 and also in 2023. So that ends the incentives, right? Now, how does this benefit you, right? I want people to get away from making decisions really on the tax incentives, because you will not be, well, it depends, but in general, 80% of my clients are not profitable from day one. They're just simply not. And I want to highlight today a case study. I've done a really very simple case study of a 5-year tax planning for a general company that is set up in China. And I'm hoping that this will help you to understand that your decisions should not be solely based on the tax incentives that are being offered. And also realize that with most of the tax incentives that are being offered, even, I would say the majority, maybe not even the majority, half of them will have a deadline where you will see an end date of when they will be applied. And others, there's an open date to it, but you can be sure that in this market, it will change, and it can actually change overnight. Okay. So the tax planning that I've created is this. We're looking at year 1. Your business license was issued in March 2022. So right now, your registered capital, which is your working capital, is 100,000 US dollars. The capital is going to be used to fund all of the local expenses, which is headcount, salaries, potentially paying suppliers, whatever the case might be. All right. Now, the question here is that I would ask people in this period between March and December is, do we need to repay the shareholder for all of the initial upfront costs for the setup of the company? The initial upfront costs could be lawyer fees, headhunting fees, rental amount for the space you're going to rent for your registered office address. It could be marketing fees. Now, what you need to realize is that all of these initial upfront costs are tax deductible as long as they're repaid within the first year of your operation. So you would have from March 2022 to February 2023 to pay this back, okay? And then it can be considered as a tax deductible item, all right? What you need is to have a contract set up to say that the shareholder has paid for these initial expenses. You need to attach in the appendix all of the receipts for all of these initial payments that have been made. And then your HQ will issue an invoice amounting to that. The contract and the invoice needs to be registered at the tax bureau, which can always take about 2 to 6 weeks to happen until you can then finally go to the bank. Then you pay the VAT on that, and then you can actually repatriate out. And the VAT could potentially be exempt as well, okay? But it's then a negotiation with the tax officer. So I want you to be aware of this because it's important. Year 2, we're looking at January 2023, okay? And I usually have a 4-point checklist, which is initiate repatriation strategies. We want, as you know, I've just said it, when you are trying to repatriate funds, for example, for the initial setup costs or for trademark licensing agreements, you need to have a contract in place and get this registered with the tax bureau. That can take 2 to 6 weeks. We need to get those up and running because we don't want to get into a situation where suddenly you're like, oh, I need to repatriate funds and I can't do it anymore. So we want these agreements to be set up as quickly as possible. And we do that starting from the year 2, depending on when you've been set up the year before. Because I don't want this to be a fixated point in year 1, because really we want to do the accounting foundation, ERP system development, and all of that in year 1, which is not really necessary for your tax planning, but it's just things that you have to think about to create your foundation. This is step 2. Obviously, if you're planning to be profitable from year 1, this has to happen in year 1, okay? Then we think about transfer pricing, because probably as you've been set up, transactions haven't been rolling so quickly, okay? But have you thought about transfer pricing? Working capital is going to be utilized to pay for all expenses from March 2022 to, let's say, March 2023. That's the budget you created. The 100,000 US dollars will survive you for 1 year. Do you need more? Is there enough revenue coming in to sustain the business? If not, how are we going to get money to sustain the business? Is it by increasing the registered capital? Is it by creating service agreements between China and your headquarters to get money in? Is it by using your foreign debt loan? Okay, at some point that working capital is going to run out. What are you going to do to be able to sustain the business? That should be your focus at that period in time. Year 3, January 2024. Revenue potentially is still not enough to sustain the local business for a variety of reasons. 1, you might have increased your expenditure on marketing and brand awareness. You might have increased headcount because you want to build momentum, right? Or you might say, you know what, we're going to step back and cut down on expenses because there's a pandemic, okay? Now, you've got to realize in year 3 that this is the point where you need to be consistent and you need to scale up in order to make sure that you're earning enough revenue to pay for your expenses, to pay for your costs, goods, services, and to pay for your general administration expenses. Now, I just want everybody to realize we're in year 3 here. Still not profitable. You're actually just trying to survive, right? Again, that's how you are in China. It's a startup period. So you're still trying to survive. If you based your decision on Being based in Shanghai because you're going to get the 15% rate, or you're 3 years down the line, who knows if that rate will still be applicable. Okay, now year 4, January 2025, company is almost break even. I'm hoping. So my rule of thumb is usually break even point is end of year 3, start of year 4, year 5. Okay, and that's what I try to aim for all of my clients. Revenue is almost at a level to cover all expenses on a quarterly basis. There might be up and down fluctuations on a month basis where you earn more or you earn a little bit less. Now, the question at this point comes, especially for those that are so worried about keeping money in China, is if there's an excess on a particular month, do we then keep the capital in the account for an in case of emergency, or do we repatriate? Because this is the point where you have to start thinking about when you're going to initiate your repatriation strategies, which is your trademark licensing agreements, your management fee agreements, etc. When are those actually coming into play? Because those will only come into play, right, when you start making money. They're not going to come into play if you're in survival mode and you're just trying to pay your expenses. They will come into play when you've got a bit of excess. But you have to be strategic about this, because you need to think about what capital do you need to invest into the company to, again, scale and maintain the momentum. Okay, so think carefully, right, about these aspects. Now we're in year 5. It's January 2026. I like to hope that by the 5th year, the company is profitable. Again, every company is going to be unique. I've made this really as a case study. But the hope is obviously by the 5th year, you're profitable. Revenue is stable, operations are leveling out, and the company is still scaling up, but it is stable. You're not thinking, oh my God, my cash flow, month, next month, next month, next month, okay? Now, my question to you is, in 2026, what will be the tax rate in China? I don't know. Will it be the unified rate of 25%? Will there be tax incentives? Will there be tax incentives for SMEs? Will there be tax incentives based on location? Will there be tax incentives based on the industry or sector you're in? I don't know. Nobody can tell you this because there's so many sudden decisions made about when rates are going to be changed. Okay? So the thought process, though, in this tax planning is, how can we minimize our tax exposure? Because again, the goal is tax optimization. We don't want to avoid taxes. We know we have to pay them, but we want to make sure that our structure is going to be solid at this point, year 5, that we can minimize our tax exposure. Okay. Now, if we are profitable, do we immediately repatriate funds out, or do we pay some profits tax to keep everybody quiet, including the tax officers? Right. So if you're, for example, an SME right now in year 5 and you're profitable, I would say with a 2.5% profits tax, pay it. That leads to your tax officers not being suspicious about what you're doing, about the type of repatriation strategies you're developing. It avoids any form of tax audit because you're starting to pay taxes. So it does lead to one thing to another. So again, it's a strategic decision now. How are we going to take advantage of the tax incentives that are going to be applicable at that moment in time? How we're going to minimize our tax exposure, but still avoid any form of suspicion from the tax officers. Balancing act, not easy. Okay, so again, just with this whole tax planning exercise, I want people to realize that the goal is tax optimization. We have to pay taxes somewhere. We don't want to evade taxes because, quite frankly, the tax officers in China are getting more and more clever on how to detect tax evasion, especially by reading through agreements, invoices, etc., and the frequency of those invoices. So it's important to make sure that you are creating a foundation within your company that allows you to optimize everything, but avoid the tax officers being a pain in the butt and nagging you. Okay. Now, I just want to finish off today by giving you 3 tips. One is doing budget creation per month for the fiscal year. Thinking about projected revenue, cost of goods, all of these types of things. But my suggestion is also to create two sets of books, which is absolutely legal in the sense that I'm talking about it. I'm not saying hide figures or hide transactions, which used to happen in China quite a lot. No, I'm saying two sets of books. One that is obviously based on FAPCA accounting, because that's what has to be submitted to the tax authorities. But having another set of books that's on an accrual basis where you can look at the true reflection of your company in that moment in time. Because doing it on the FAPCA basis cannot always be, it's not always aligned. The second tip, talk to your tax officer. Don't fear them. Talk to them. Have open dialogue, open communication. And if you're not getting that from your own accountant doing that work, then go with your accountant to have those discussions and have them become the translator. It also gives you great insight to see what a tax bureau looks like and who your tax officer is. I think it's always important to meet who your tax officer is, right? But have that open dialogue. Don't try to hide anything. If you start hiding things, it's all going to be revealed at some stage in your development. Set up repatriation strategies early in the game so that the contracts can be approved. Treat FAPCAs with respect. Have a clear FAPCA standard operating procedure, compliance procedure. Know who is holding them, who is purchasing them, who is issuing them. Make sure, I know there's human error, but make sure that when you're issuing the FAPCAs, the data that is on them from your customer and yourself is always accurate. Tip 3 is communicate with your Chinese accountant, whoever that might be, okay? Business strategy is tied with the finance strategy. If you don't involve your accountants in that, they can't help you. They can't advise you. They can't tell you what you can and cannot do, okay? They cannot also act then as a financial controller to your business to say, hey, you're spending too much. Hey, we got to cut back. Hey, we need to maybe perhaps restructure something, all right? Now, I've done a recording on how to work with your Chinese accountant. It's up on our YouTube channel, but I'm going to do another session in May on that as well to help you to really understand what an accountant should be doing for you on a day-to-day basis. I think sometimes people don't realize what's involved in that, okay? Your thought process when having an accountant, again, whether it's somebody in-house or somebody you outsource, is what's the value that they're going to bring to your organization to optimize it, make it more efficient, create company policies, etc. Okay, and you might all be thinking, well, Shannon, we're so small right now. Yeah, you're so small right now. This is the time to do it. Not later on when you're scaling up and your focus should be on business, on the actual core functions. It should be now when the business is quiet, right? That's what these people should be doing in this period. All right. So for our roundtable event, I mean, it's only Gaius and me. Gaius, I don't know if you want to unmute yourself or not, but the question that I wanted to have for our roundtable was, after listening to this presentation, do you think it's even possible to do a tax planning exercise, considering that the regulations consistently change? If I'm just going to start off on this, tax planning is critical. You need to have tax planning put in place. I call it scenario building. Here's scenario A, if, and then you make assumptions. If this and this happens, this will be the tax rates. Scenario B, if this and this happens. Again, this is where your accountant comes into play to create these scenarios for you so that you have a clear understanding. If A happens, if B happens, if a combination of A and B happens, you know in which direction you're going into. So that's what, for me, is really important. Is it difficult? Absolutely. But these scenarios are not something you do in year one and then you forget about them. If there are consistent changes in terms of tax rates or regulations, these scenarios start getting amended, right, continuously. And it's basically doing forecasting. So this exercise is extremely important. And these scenarios should be consistently updated based on the changes that will occur in China over time. That's the end for today. Happy to have a discussion. If anybody is watching this on replay and you've got questions, don't hesitate to reach out. For those of you that are new to the Thrive in China community, this is just a little bit about what we offer as services. And Gaius, you're very welcome. Glad I could help you. And if you're interested, so basically the advantage of the Thrive in China Roundtable is that it's one registration for all events up till the end of the year. We have the following events coming up. So April 20th, sorry, in April is the one about communicating with your Chinese accountant. But next week, we're talking about VAT, week after tax audit, internal control systems, profit repatriation. The topics currently are very much focused on those of you that will have entities in China or are about to set up entities in China. But we will be going into more marketing and branding discussions after April 20th as well. So stay tuned for that. Gaius, thank you for joining me. And for anybody who's watching this on replay, again, if you've got any questions, don't hesitate to reach out. Have a wonderful day. Take care and bye.